Hello, on today's edition of The Final Bar, we'll look at the market activity through a couple different lenses. Number one, we're going to look at a commodity corner segment where we break down the commodity complex, think about the movements in oil and precious metals and other parts of commodities, what they mean for your asset allocation decisions. Also hear from Rick Bensignor from In the Know Trader, a fellow StockCharts TV host. We sat down with him last week at the Money Show in Orlando. Ladies and gentlemen, this is The Final Bar. Hello, everyone. Welcome to today's edition of The Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in Redmond, Washington. Thanks for joining me every weekday after the close to look at the short-term price action, connect it to the long-term trends. We seem to have a continued upside regime here. We continue to see upside follow through with stocks. Every time it feels like we have divergence, we have distribution, we have potential negativity, the next day sort of resolves to the upside. That's been the story for a while now, and today seems to be the similar sort of feel. Interesting, though, today to see energy up at the top of the list. Energy has been a consistent underperformer, especially on up days. That's sort of flipped with oil prices and energy as a whole holding up very nicely. So today we thought we'd have a segment called Commodities Corner, where we really break down the movement in commodities and think about them high level and then also micro on some of the individual areas within the commodity complex, just to do some thinking how that relates to other items. Rick Bensignor is my guest today. We sat down with him last week. He had some great, just quick thoughts about the overall market environment, especially equity outlook for the rest of the year. So excited to bring his thoughts to you. I did want to highlight what's coming up here on StockCharts TV and also on The Final Bar. Very exciting that our new show Behind the Charts actually just premiered this week on Monday the 10th with an interview with Tony Dwyer. Tony's fantastic. His interview was really interesting. Next week on Monday, February 17th, we'll feature our discussion recently with Eric Balchunas. He's the ETF strategist at Bloomberg. Had a really good discussion about the ETF environment, what it looks like, what to expect. So you're really gonna learn a lot, getting behind the scenes, behind the people, behind the charts on our new show. Also wanted to highlight, coming up this Thursday, February 13th, we have the YouTube live Q&A. So if you go to our YouTube channel for StockCharts, hit subscribe, hit the notifications, you'll get an alert when we go live. We'll bring up a couple charts and then just have a great conversation about what we're seeing, answer all of your questions real time through YouTube. You'll see on the screen also other guests. We have Chris Bretcher coming up this week. Next week we have Jim Smith, Leslie Juflas, and Sam Burns from Mill Street Research. So some really interesting personalities with some great takes on the market. So I hope you can join us. And if you miss any of the episodes, just go to our YouTube channel. You can see all of our previous shows. We need to move into our next segment, which is the market recap. So when I mentioned at the top of the show, I think we see this resilience with stocks. We see this continued upside. And every time I get all excited, I see some potential divergencies, I start telling you about them, I feel like the next day we resolve higher. That is pretty much what a bull market feels like, to be honest with you. But what concerns me, this is what the later stages of a bull market tend to feel like too, right? You have all these divergences, but then we still sort of trip higher, even when it feels like we shouldn't, right? It feels like there are all these reasons why the market should go lower, continues to shrug off those concerns, those potential issues. The coronavirus has not disappeared, it's still there. Who knows what the impact is gonna be, but stocks keep resolving higher. So let's try to unpack some of the technical themes that we're seeing here. When you look at a daily chart of the S&P 500, again, I always go back to Dow theory, which is technical analysis 101. Is the market making higher highs and higher lows, or lower lows and lower highs? Today is once again a confirmation of a higher high. We have a new closing high, a new intraday high. Stocks are in great shape. Until that stops happening, the trend is up, and you want to continue, I would say, to lean into the equity part of your asset allocation, right? Thinking, as long as this trend continues, the trend remains very, very positive. We're pretty close to negating this bearish divergence, which I've mentioned recently. What you want to do is you want the market to break to new highs. You want the trend line to be broken. Arguably, that's all happened right now. So you want to see, if the RSI continues higher, that sort of further validates upside in stocks. But at this point, the trend is your friend. Seems to be going higher. Stocks in form of the S&P 500 up about 2/3% today. The NASDAQ up just under 1%. So technology-oriented spaces definitely did pretty well. Small and mid cap up just a little bit more, so it's pretty even, but it's more in line with a traditional bull market phase where you see small and mid leading the large and mega caps. So sort of a normal up day today, except for the sector rotation part of it. So if you look here, you see energy number one. So energy's rebounding off of some obviously very depressed levels, and so commodities in general looking pretty good, except for the precious metals, gold and silver. Energy at the top of the list for today, followed very closely by communication services, then technology. At the bottom, you have some traditional defense. You have consumer staples and utilities at the very bottom. So that sort of all makes sense. So the two sort of outliers, energy at the top, financials toward the bottom. And I think in the 3-on-3, I've got a couple of financial groups to look at because it's a bit concerning that you don't have financials participating in the upside here, right? Ideally, in a healthy market environment, you'd want to see a lot more participation from that side of it. In terms of global markets, you have China, Asia-oriented, as well as commodity-oriented markets like Russia doing very well. And so, some sort of a relief rally, sort of a nice rally in the context of what all is happening. I wanted to spend just a few moments looking at individual names because we're going to be going into some other asset classes. I want to make sure we hit some of it. It's interesting, charts like MPC, which again, energy's up pretty good. This is a big integrated oil company. This is a group and a stock, to generalize, that I think people have sort of forgotten about. They've been such consistent underperformers. You can see the relative strength line in the last 3 months has been pretty weak, but all of a sudden it's just starting to turn up. You see the relative strength making new peaks. The RSI is now overextended. It's just turning up, coming out of an oversold region. It's now back above the 200-day, now back above the 50-day. So all of a sudden you start to see this rotation. Again, I'm always looking for themes that I think people are unprepared for, or underpositioned for. Energy doing well is certainly one of those themes. So I would be looking at some of those energy charts that we've sort of forgotten about and see what sort of improvements you might see in there. Another one's JW Nordstrom. It's funny, these are stocks that have sort of been out of favor. They've been relatively weak, but starting to just be a little more constructive. So JW Nordstrom putting in a bit of a higher low in the last couple days. If we can continue that strength, go to a new high above 41, that would certainly rotate and make this feel more like a short-term pullback type of pattern instead of a breakdown, much more weakness in store pattern. So I think a couple of these names that are on the biggest gainers list for the Scooter reports might be worth looking at. Gap is another one that strikes me as just sort of this slow and steady uptrend. The relative performance has been very weak. I think there's a lot to be done before a stock like this looks good from a technical perspective. But right now you have a real clear line in the sand. 19 is sort of that resistance level. So if and when it's able to eclipse that, that would put it back above the moving averages, back above the most recent swing highs, moving more in a constructive pattern. The last one I just wanted to point out to you was Wynn. So the gaming stocks obviously really clobbered by the coronavirus news out of China. A lot of these have an exposure here. But it's interesting to note that Wynn has now put in a higher low and now put in a higher high. It's broken back above the swing high from the first week in February. Compare that to LVS, which is in the same group, Las Vegas Sands. All of a sudden, these stocks actually start to look pretty constructive, right? So they dropped very heavily, but once the market sort of digested the news, sort of right-sized expectations about what the impact is going to be, the stocks are recovering very nicely. And don't look now, they're actually in line to head back to previous highs. So I think both those stocks, Wynn and Las Vegas Sands, are worth keeping an eye on just to see if we continue to see improvement in price, but especially in relative performance. These are stocks that are improving at a time when others are sort of tapering off a little bit. So that's a quick market recap. And again, I avoided commodities because we're going to get to that momentarily when we do our segment on the commodity complex. But I did want to introduce our mystery chart. So what I like to do occasionally is show you a chart, cover up the tickers, cover up all the identifying characteristics, and have you guess what it is. There's a reason why I'm going to show you this. I'll tell you why it's an important chart to follow later in the show. So my question to all of you, what is this chart? The only hint I will give you, this is a security, an equity and or ETF that's traded in the US. That's about it. I'm looking at daily price for the last 2 years. I'm looking at RSI. I'm looking at relative strength to the spiders, to the SPY at the bottom. So this, you can see, testing all-time highs, testing the high from the middle of last year. So what is this? ticker. If you have a guess, just go to the Q&A panel on the StockCharts TV page, put in your guess. Later in the show, we'll take your guesses, unveil what this is and why it's an important chart to pay attention to. Our next segment is Commodity Corner. So when we talk about commodities, one of the things that we've talked about with the show is focusing on some different asset classes, really thinking about what they mean and why they're important to you. So what I wanted to dig a little bit into commodities. Today is one where commodities as a group up pretty big, energy the top sector. And again, this is so unusual because it's just not been the case for so long. So I really wanted to sort of look at the commodities charts in a little more detail. We'll start with some broad commodity indexes and then go through some specifics like oil, gold, and others, and just talk about what we're seeing with each of those. Now, when you start at a high level with commodities, it gets a little complicated only because any commodity ETF has a lot of assumptions it's kind of making, or a lot of ways it needs to adapt, because commodities are obviously traded as contracts. You have to roll contracts, and so there's a classic issue where something like the USO tracking oil doesn't really track spot oil prices exceptionally well because you have this rollover and this, sort of this decay in the value built into the way that the ETF is constructed. So what I found with a lot of these, they are great at, in any way, they're usually very good at telling you the short-term movement. So if you want to know what commodities are doing, bringing up a ticker like DBC, which is one of the broad commodity index ETFs, pretty decent idea of what's happening. But the longer term you get, the less and less it might be related to the actual long-term performance of the commodities. However, this is how I found a lot of investors, and especially financial advisors, are able to add exposure to commodities for a relatively low-cost structure. So that's why I like to use the ETFs. Good transparency, good data, even though if it might not necessarily match the returns on the actual commodities. When I'm looking at a chart of the DBC, this is one of the ones that I follow very, pretty broadly for commodity performance. A lot of these have actually tested long-term support levels. So if you look at the last year, it's essentially been in a range. Commodities came off very heavily in the fourth quarter of 2018, rallied in the first quarter of 2019 along with stocks, but since then it's really been range-bound. It's a pretty wide range, but it's still a sideways trend, right? If I drew an arrow, it would be dead sideways for the last year. So what's happened is when something's really range-bound, you're looking for when it's materially weaker or stronger than normal. And we can see that it's tested price support. This is the DBC getting back to the lower 14 levels. It was oversold, which lines up pretty closely to what we saw back here in November of 2018 before one last push lower and the eventual ultimate bottom. So it's starting to show characteristics similar to previous bottoming patterns. And what you're looking for there is starting to see a reversal of this pattern of lower lows and lower highs. So it's now established a higher low, now established a higher high going above the previous swing high from last week. So potentially starting to set the stage for improvement. And so overall, you think from a risk reward perspective, upside back into these levels, which was the upper end of that range, minimal downside, because it really hasn't gotten much lower than that. So overall, potentially compelling here. Now, there are a couple different ways to look at commodities. They all have their own challenges. So the other one that I look at a lot is the GSG, which is the Goldman Sachs GSCI commodity trust. This is from iShares. Looks very similar because there are similar weightings to what you saw with DBC. The only other one that's kind of very different is the GCC. This is a continuous commodity index, and it weights the commodities a little differently. So a lot of the commodity indexes are really geared towards energy, so they have a big weight on oil. So it'll be, oil's movements up or down will really change the value of that index. Something like the GCC is a little more equally weighted, so it's less of an impact on oil. Will give you a broader sense of what commodities as a whole are doing. Here we see a bit of a different picture. You see the rally from the low in August of 19 to the peak end of December of last year, pulled back about 61.8%, a little bit further, totally fair, and then rallied back up, and now it's testing the 200-day moving average from below. So I think if it's able to reclaim that 200-day, get back up into the 18 handle, would be sort of a similar thing to what we talked about with the last two charts, the DBC and others. If you're able to, continue to make higher highs, higher lows, and sort of continue that pattern, it would set the stage for a much more constructive picture of commodities. let's look at a couple of the individual commodities and just what we're seeing, what they're saying. So when looking at gold, I tend to look at the GLD as a starting point. The gold index is great for long-term trends, and GLD tracks it very, very well because it holds physical gold. One of the patterns I've seen with gold, and gold is one of the weaker commodities today. It's one of the couple that's actually down while most of them are up. So it's a bit of an outlier right at the moment. What I've seen here is this pattern from the last 6 months to the first 6 months of 2019. So you had this big run up. You had a pullback about 38.2% of the way to that first Fibonacci level. It broke above trendline resistance, retested the highs, and broke out. You can see that same thing happened here the second half of last year. You had the big run up. You had the pullback about 38.2% of the way. You broke above trendline resistance. You retested the highs. Then, in both cases, you had a bearish divergence, a higher highs in price, lower peaks in RSI. We saw that last summer. You also saw that in the last 6 weeks, where you saw the higher highs in price, lower peaks in RSI. So the question is, does this divergence hold? Is this an indication of an exhaustion of the uptrend, a rollover? And I think for that, you'd look for a break on the GLD below 145, below the 50-day moving average. That would sort of continue this swing pattern and go below the most recent low, most recent support level, close this gap from the beginning of the year. That would certainly be sort of short-term negative for gold. Or option B, scenario B, do you see a similar pattern to what we saw here last summer, where you had that bearish divergence, a bit of a pullback, and then it blew right through those highs, suggesting much further upside momentum. And again, gun to my head, what would I expect? I think it's more the latter than the former. I could see this resolving higher as long as that 145 level sort of holds. And so that's sort of the line in the sand that I'm thinking of with something like gold. Oil is an interesting one, and you can look at it a couple of ways. I'm going to look at the WTI continuous contracts, just looking at futures. It's going to update at the end of the day, so this isn't updated yet for today's trading. The USO is a great way to just see short-term ups and downs. So it's going to be up here a little bit in the 51-ish range, I'm guessing, based on what we saw at the USO today. It's rallied pretty good. What's interesting with oil, it reminds me a lot of the commodity index charts, where you have a relatively weak position. It's at the lowest levels. It hasn't been in the 40s for the longest time. We often talk about the big round numbers, right? Oil being below 50 might be a meaningful thing that people are paying attention to. But what I think is very interesting is the oversold conditions. If you look at the RSI, it was oversold back here in June. That sort of established the lower end of that range. We're a little bit lower. And now also RSI oversold, suggesting that similar sort of weaker pattern. So, again, it's so depressed as a bottom fishing idea, potentially could be the point at which you see oil come up from here in some meaningful way. Overall, the RSI and how that resolves is going to be the thing that I'm sort of looking for. And is it a similar pattern to what we saw here with, the next move down has a higher RSI? We'll have to see if that happens on any sort of pullback rebound in the price of crude oil. Those are just a couple of the commodities, and again, there are a lot of other things like natural gas, like copper, which again, we don't unfortunately have time to go through each of these, but I'd encourage you to think of commodities, think of it big picture, think of it holistically, and I would use some of the tickers that I've shown you here, the GSG, the DBC, the GCC, sorry for throwing a bunch of acronyms, but that's the idea. Those are the three main commodity ETFs that I would follow, and then go next level down and start to understand what the movements are in commodities. And overall, again, I think some potentially constructive long-term patterns in gold, potential really bottom-feeding opportunity with oil, and we'll have to see what happens next. That's our commodity corner for today. I want to take a quick commercial break. Back with my guest, Rick Bensignor, some interesting comments about stocks going and interest rates going through the next couple months. So we'll be back in a minute. Hey everyone, welcome back to the show. Thanks so much for joining us every weekday after the close. Please keep your questions and your feedback coming to us. The final bar at StockCharts.com is the best way to get your questions to us. We'll have another mailbag segment later in the week. We'd love to answer your questions. Or during the show, just put a comment in the Q&A. We'll make sure we capture those and use them very soon. Wanted to introduce my next guest, Rick Bensignor. We sat down with Rick at the Money Show in Orlando last week. I've known Rick for a number of years. He was actually my predecessor at Bloomberg a couple of years ago. We've always kept in touch, and we had a mutual mentor and friend in Tom DeMark. We both worked with Tom very closely, learning his techniques and working with his content in our particular role. So it was great to catch back up with Rick. Hear what he sort of saw with the overall market environment, particularly with stocks and with interest rates going through the next couple weeks, next couple months. So here's part of my conversation with Rick Bensignor from In the Know Trader. So speaking of making money, we're recording this February 2020. Stocks at or near all-time highs. Gold, as we mentioned, has rallied. Bonds in a constructive, it feels like everything's in a constructive pattern. What is your toolkit telling you now? How would you be positioned? And let's say you had new assets to employ right now. Where would you put them, do you think?
Right now, I'm not putting them in stocks because we hit this 3,336 target, and we're still within 1% of it either way. I think we're going to spend some time here. Now, am I bullish for 2020? I am. I think minimum upside price that we will see at some point this year is 34.77. So I say, there's still another 3% or so to go above where we recently went. But could we back and fill in a bad news headline coming out of China now? Could we even take out last Friday's low when we got down a couple hundred points? We could. So I'll still be looking for a net buyer, but not here. Bonds have been tough all year because they're still 1.95% in the 10-year on the top side, about 1.5 on the bottom. It's really been range trading. We've got three long-term lows: 2012, 2016, and 2019, all at 1.4 plus or minus 10 basis points. So you really have a long-term triple bottom. If we take out the triple bottom, my next target would be about 1.25. Do I think we're going to negative interest rates? No. What happened last summer? All you heard, recession, recession, recession. Every person on TV is talking about recession. I wrote, the likelihood of recession is minimal. Why? Part of it is everybody saying there's a recession. And where have they been for the last 3 months? Nowhere. One headline I wrote, where are the recessionistas? They're gone, right? The market flew up and now nobody's talking recession.
It's not on
right, which means maybe you have a better chance that timing was wrong. But maybe 2020 or 21 we do see a recession.
Sure.
That's the game.
Interesting.
That's about outsmarting people and trying to figure out when the consensus idea is that it's definitely going to be this. I always look for why is it not going to be that? And if I could time when it's not going to be that, then I've got a high chance of a successful trade.
So that was just a bit of my conversation with Rick Bensignor. That was part of a longer conversation, about 20 minutes long, that we had last week at the Money Show in Orlando. Rick is a very thoughtful analyst. If you've not watched his show, In the Know Trader, you should check it out on StockCharts TV, also on our YouTube channel. I love his take on equities and just thinking about what could happen. But for him, what strikes me about Rick's process is it's always about the evidence. It's what is happening and paying attention to the trends, paying attention to potential exhaustion signals. So it'll be interesting to see what his toolkit tells us over the coming weeks, coming months. If that sort of conversation is interesting to you, make sure you check out our new show, Behind the Charts. Airs every Monday around 12 o'clock Eastern, featuring some longer form interviews with people like Rick Bensignor. Should be really, really, really interesting. We're going to move on to our next segment, which is the mystery charts. My question to all of you, did you figure out what it was? Guesses from the chat room. We have IBB, decent guess, and congratulations, Final Bar Nation, as always, doing very, very well. That is absolutely it. It's the Biotech ETF, ticker IBB. I put this in here because, we've talked recently about biotechs being a key group to pay attention to. It's not that the market can't rally without biotechs, because it can. And it's not like if biotechs are weak, then that's the end of the world, because it might not be. But what I am seeing is, just thinking of a group that I would want to see doing pretty well if I wanted to feel good about the position of equities, this is one of those that I would look for. Semiconductors, we've talked about a lot. It's a great sort of leading indicator for market strength, right? Tends to do well when the market's doing well. Biotech is the kind of group that I like to see holding up very well. And it was a bit of a concern when you saw the IBB selling off, breaking through a new swing low. It set a low in the beginning of January, sort of broke through it pretty meaningfully in the second half of January. A bit of a concern, but if you look at what's happened, it's returned right back up to pretty significant resistance. So this is resistance going back not just from a couple months ago, but from all the way back here, September, October of 2018. So this is, really the peak before the big sell-off into the market low, end of December of 2018. We're back up to those levels, overall doing just fine. Relative strength overall has been muted, and a big part of that is basically the sell-off here at the beginning of the year while the average stock was doing pretty good, or definitely the market was doing very, very well. What I like about this chart, though, is the fact that the RSI is not quite overbought. It's not overbought suggesting we're exhausted or that we're at some sort of extreme. It's kind of holding up pretty well. So I like this as a chart to watch because one of two things happens. It's not going to be just sideways forever. It's either going to break above 124, finally sort of get above the most recent swing high, in which case this feels like a big cup and handle-like pattern of a big rounded bottoming pattern, a shorter-term correction, which is sort of building momentum before a nice breakout and potentially much further highs, or it starts to break down through the previous swing low around 121, starts breaking down through the 50-day moving average around 120. And if I'm seeing the IBB, that for me, I'm setting an alert on StockCharts for IBB breaking below 120, because that for me would tell me to revisit this and think whether or not it's suggesting further downside, further weakness in what I would see as a key group. So team final bar, nice guess. You're absolutely right. IBB is it. I will continue to try to respectfully frustrate you with more and more difficult tickers down the road. Great guessing. We are going to wrap the show today with the 3 and 3. So at the end of every chart, or end of every show, we do 3 charts in 3 minutes. And here we go today. So the first chart is semiconductors. We just looked at biotech as our mystery chart, but semiconductors, if I had to look at one group as a leading indicator, as an indicator of overall market strength, besides just the S&P 500, the semiconductors would be it. We usually look at this in the form of the SMH, which is a pretty liquid semiconductors ETF. Here we're looking at $SOX, which is the Philadelphia Semiconductors Index, pretty widely followed with institutions. Interesting to see this beautiful, consistent pullback to the 50-day that keeps resolving higher, testing highs. This was the bearish engulfing pattern from the 3rd week in January. We're retesting those highs. New closing high today for the SOX, which is pretty interesting. Not quite overbought. The relative strength testing new relative highs. Overall, this chart is holding up beautifully, and I think that speaks to the strength in equities as a whole. Sticking with this sort of industry theme, as I was going through my review this morning, a number of industry charts sort of stood out to me. And so all 3 of these actually are industry groups. Second one is the banking index, $BKX. So what's interesting here is it sold off through the 50-day at the beginning of January, and that's why the relative strength is so bad. You had big mega cap technology, communication services doing very well, even consumer, and all of a sudden you have the banking index going down. That's what causes severe underperformance, down almost 10%. Just in 6 weeks going through the end of January. Since then, it's rebounded a little bit, but now it's failed a couple times trying to get above the 50-day moving average. So both times traded above, closed back down toward the lows. We saw a similar pattern today. So the short-term read feels like it's bouncing up against a level at which buyers are not really interested in pushing it much higher. That doesn't feel great to me. The RSI is right about dead even at 50, which is sort of neutral, and the relative strength continues to be relatively weak. So just like semiconductors looks relatively strong, I think you see with the banking index relative weakness that concerns me about the XLF and financials participating in the upside in stocks. But where we do see some interesting movements in the financial sector, to our 3rd chart of the 3 and 3 is the insurance index, $INSR. So if you look here, you're actually seeing this rally from the first half of 2019, this basing pattern, which I'd sort of see a sideways consolidation pattern between 10,400 and change. That's the peaks from last July, last September. We pulled back a number of times down to the 200-day moving average. Now have resolved back higher and now gapped up through that resistance level. We pulled back a little bit today, but overall I would be interested to see if this level is able to hold. If we're able to hold that resistance level, if resistance becomes support, that's what we would call, as a technical analyst, call that parity, where a support becomes a resistance level and vice versa. So you're sort of seeing that potential pattern here around 10,400. I would like to see the insurance index remain above there, the relative strength continue to improve, and all of a sudden within financials, there's sort of a place to be, even if the XLF isn't doing fantastically well. And ladies and gentlemen, that's our show for today on a Wednesday afternoon. Thanks so much for joining us every weekday on the final bar after the close to break down the price action of what we're seeing. I would remind you, tomorrow on the 13th, we're going to be doing our first YouTube live Q&A. So if you haven't checked out our YouTube channel, go to our YouTube channel. Make sure you hit subscribe, hit the little bell for notifications. The moment we go live tomorrow, you get a little ding on your phone, on your webpage. You can go right to us, ask some questions of us real time. Should be a really fun, interactive, quick couple minutes to spend together. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Have a great night.